So the asset pricing model takes into account the beta of a stock, that is the risk in investing in that particular security. And also the market risks of investing in that particular security also takes into account the beta, that is the risk of the stock itself. So essentially, it takes into account the risk-free rate, the market risk, and the risks of investing in that particular stock. So it's a very, very important metric in determining the cost of equity. It's very, very important metrics in determining the cost of equity. So having the beta of a stock or having the beta of a company, then we can use that beta to now estimate the cost of equity, which we will later on weigh that cost of equity by its target capital structure or its optimal capital structure, and add that to the weighted cost of debt in order to come up with the weighted average cost of capital. So our WACC analysis is going to be based on a target capital structure, which is our weight of the proportion of equity and the proportion of debt. And then we will later on, after weighing the proportion of equity and debt, we will later on multiply the proportion of equity by its cost of equity and the proportion of debt by the cost of debt. That is the cost of debt here. In this case, it's going to be the after-tax cost of debt, because debt has an interest expense that is tax deductible. So it's tax deductible, so it becomes an after-tax of debt. That is, there is that tax shield in issuing debt securities. So that after-tax cost of debt will now be used to calculate the WACC. So there is something very important in weighted average cost of capital analysis. There is something very important. And one of the things I want to talk about here is why would companies take so much debt? Why would companies take so much debt? Why do they go about taking so much debt? The reason why companies go about taking so much debt rather than issuing equity is because issuing bonds reduces the cost of capital. Why is that? It is because of tax savings. It is because of the tax shield that is hidden in the interest expense. So the interest that is paid on debt is tax deductible. So that tax, it is the government compensation for companies who take debt in order to finance the business. So the higher the proportion of debt, the lower the cost of capital. And the lower the proportion of debt, the higher the cost of capital. However, there is always an optimal capital structure. There is always an optimal capital structure where a certain proportion of debt shouldn't exceed that target capital structure. Why is that? It is because of the effect of bankruptcy. The effect of bankruptcy. So if a company issues more bonds, once the proportion of debt is equal to the total value of assets of the company, then the debt holders might sue the company and claim bankruptcy and claim the assets of the company. Why? Because that is already a bankruptcy effect where the assets of the company is directly equal to the assets of the bondholders. so they have the right to take over the company. However, bankruptcy cost needs to be estimated with the effect of the tax shield, that is the tax savings that comes from issuing bonds or issuing debt securities. So what we are saying essentially here is that there is always an optimal capital structure that a company shouldn't breach. So say for example, if the company is generating a tax shield of say $50 million, then that $50 million should be directly equivalent or able to offset any bankruptcy cost in the future. So while the company is generating the tax shield, then it has to be altered, it has to be offset, it has to be offsetted by the future bankruptcy cost. So we have to determine the future bankruptcy cost, and then if that amount is greater than the tax shield or the tax savings, then the company needs to be very alert or takes a caution on that. So basically, companies shouldn't exceed their tax shield. The bankruptcy cost shouldn't exceed their tax savings. So the bankruptcy cost must be equal to the tax savings for them to arrive at the optimal capital structure. So that's exactly what we are seeing here. So bankruptcy doesn't have a specific definition. So all we can say here is that once the assets of the company is equal to the assets of the bondholder,